In today's video, I'm going to be going over structure and setups. This is going to be for any sort of traders, whether you're new to trading or whether you've been trading for a long time. Everyone's going to be able to take something from this video. The market has three main structures. We have trending structure, ranging structure, and initiation structure. I'm going to cover all three, how to use them and how to understand them. And then I'm going to show you how to build setups based on those structures in the market. So the first fundamental that you need to know is how to read market structure. Back when I was learning how to trade, this is the only structure that we actually knew existed in the market, where we get those higher highs, higher lows, and to be in a trending market, this is the only structure that we was ever taught. So it wasn't until I actually learned how to read the market and how the market actually moves that I understood that there's more than just this one structure. And back in the day, that was just normal to understand that market structure is trend. As soon as someone said structure to us, we'd be looking for those higher highs and higher lows in the market. And that's very normal because a lot of people are only fed that one piece of information and don't really understand that structure is based on how banks move the price. So it's all these structure points that we see are points of mitigation. So we need to understand where these points of mitigation come from. Then we can understand how to read other market structures and how to read an in-depth understanding of the market. So reading and understanding structure first is very important because knowing trend means that you can get involved in some great opportunities on pullbacks, but this is only 30% of the market right here. Trending only happens around 30% of the time. Now, when we're not trending, we need to understand what other structures coming into the market. So when we started to learn how to trade smart money concepts, this is where we start to understand the logic of how price moves and who moves price as well. It wasn't until we understood that then we actually realized that structure is only a part of the game. Actually understanding where the orders are created, why they're created there, and then how they move the price to create the structure, that's when you really understand the different market structures. So the second market structure that we have is initiation structure. Now, a lot of people can read this initiation structure. Don't get it confused with trend, because we can see initiations in trends. So all these moves up, these will also be initiations in the market as well. But it's a very fast and aggressive move in one direction only. So it's a very fast and aggressive move down, or it's a very fast and aggressive move up. Now, this is where they are initiating higher and lower prices. And when I say they, I'm talking about the banks and financial institutions. These are the people that actually move the market and have the capital to move the market. Now, once they've created sideways ranges, they then initiate price in the direction that they want to move it. That shows the intention of the sideways range. And again, intention is also shown when we break structures here, as we see here. That's why these are those initiation legs in the market as well. So now the third structure is a sideways range. This is when we don't have trend, when we don't have those higher highs and higher lows, when we don't have initiation structure in the market. What we're getting is just price just running highs, running lows, running highs, running lows, and not creating any trend in the market. This is when price is just contained sideways. Now, this is one of the keys to understanding the market. And I would say this is probably one of the most important structures that you need to understand in order to read the market. Because if you can understand sideways ranges, how to trade them, how to read them, you'll be one step ahead of the intention, which means then you can get involved in these bigger moves in the market, or these bigger trending phases in the market, or the continuation phases of the trend. And this is what we found when we were learning smart money. Once you understand the sideways ranges in the market, you know what comes next, because after sideways ranges are created, they have to go into initiation structure here, which means then we break out of the sideways range, either higher or lower. Now you can understand the moves in the market. When we learned how to trade smart money and we found out and understood the logic of sideways ranges, which is where orders are created, which is where the banks and financial institutions, this is where they create orders into the market. So because they have such a large amount of capital, if they was to just buy or sell, they would create an initiation. They would create a very aggressive move in one direction. So instead of doing that, they create sideways ranges, they contain price between a low point and a high point. They create orders inside this sideways range. Basically, they buy and sell to hold the range, but then they also create orders into the market. They then initiate price That's where we go into that second structure, that initiation structure, in the direction that they want to move the price. Then when price comes back here into the future, they have buy and sell orders open, which means they're at a loss inside this sideways range. So when they come back into this sideways range, this is where they clear all the loss orders created inside the sideways range. And that's where we see those reactions, right? That's where lots leave the market, price then reacts, and then that creates that next phase of price, which again, we move into that initiation structure. And that's how we create the trend in the market, as we see here, higher highs and higher lows. So it's about understanding these three market structures, adding them all together, and then you can build an understanding of the fundamentals of how price has to move. Sideways ranges creates the orders, initiation shows the direction. When we pull back into that range, they mitigate out of their orders used to hold price. That creates the reaction. Then that creates that low, high, higher low, and higher high in the market, which creates structure in the market. So as soon as you understand that all these three structures align together, then you can understand how the market moves from the bank's perspective, and that's how you can build high probability trading ideas. If you're only focused on this one structure over here to the left, you're going to miss out on so much opportunity in the market because you're going to be limiting yourself to only one way of trading when there's three different understandings and ways of trading the market. If you know this information and if you can read the market in this way, it doesn't matter what strategy you create, it will always be based on the fundamentals of how price has to move in the market. So what we're going to do now, I'm going to go onto the chart and I'm going to show you exactly how to identify each of these structures into the market. Then what we're going to do, we're going to come back to understand the second fundamental, and we're going to apply that fundamental on top of what we've already just learned. So I'm starting here, we're on the 15-minute chart here, Euro USD. So the first market structure is trending market structure. Now, like I said before, we're either going to be in a sideways range, we're going to be in an initiation, or we're going to be in a trending market. So we're just going to start out with the most easiest market structure to identify. Now, all you want to do when you're learning is just identify any sort of trend. This can be on a lower time frame, this can be on a higher time frame, it doesn't matter. You're training your eyes to read the market structure, and that's how you get better. So now we'll start here. This is the first low, high, higher low, and higher high, right? This is the trending market structure that we see. Then we create that higher low, and obviously we create a higher high, which is above here on the chart as well. So this is a trending market, right? This is how we learn to read the trend. Now, we do also have a trend here on the lower time frame where we have a low, a high, higher low. We create that higher high in the market here as well. Higher low, higher high, higher low, and higher high. And then we break structure to the downside. So we move into a different market structure. Again, all I want to do is just identify trend in the market. I'm just training my eyes to see the trends. Any points that we can see where we get that market structure that creates that higher low and higher high in the market, I want to start to draw out. And you might see these in hindsight first, which is what we're doing now. But once you've trained your eyes to see this market structure and you've seen it enough times, you'll be able to read this in the moment. And that's how you improve your skill, and that's how you get better. And then we also have a trend here where we create the low, high, higher low, higher high, higher low, higher high, higher low, and higher high, right? So this is the market structure. This is what most people read and understand in the market as their structure, right? So now what we're going to do is we're going to understand the second market structure, which is initiation market structure, right? This is where price moves very aggressively in one direction, like so, aggressively up or aggressively down. Now, what we'll typically see on the lower time frame is new sideways ranges and initiations being created in the market. Now, what this is the banks initiating more orders into the market, leaving sideways ranges for the future, as in to mitigate out of their orders in the future, and just initiating price in one direction to aggressively buy or sell the market. And that creates new structure in the market as well. So what we'll do is we'll identify that now in the market. And again, all we're doing is training our eyes. So anytime we see initiation structure printed in the market, we know that structure is then being created. Again, when we look for a very aggressive move in the market, typically that creates that imbalance as well, where we get the gap between the candles. So this is a great identifier to understand we're in that initiation structure. So I'm just going to draw on those initiation structures now. So we see price initiates very aggressively here to the upside. We initiate very aggressively here to the downside. Again, we could consider this whole leg as an initiation because we didn't pull back deep. We just created new ranges and saw continuations. We have smaller initiations here on the lower time frames as well, where price is moving very aggressively. And then we get initiations here to the downside where price is also moving very aggressively. It's very key to understand these different market structures, because once you can identify these market structures, you can then learn how to trade with them. So as we see here, there's another one here to the downside where price moves very aggressively. We also get smaller initiations in here as well, and larger initiations where we get those higher time frame initiations to the upside or to the downside. These typically will come from a sideways range. So this is how we can start to identify that range, initiation, mitigation, continuation price delivery, because this structure that's being created in the market, these will typically come from sideways ranges, right? So when we break out of a sideways range, we're in that initiation. When we come back into a point of mitigation from a sideways range, that's again when we get that initiation structure. So this is how we can start to identify the next market structure, which is sideways ranges in the market as well. So now let's add on our third structure, which is a sideways range in the market. Now what I'm going to do is I'm going to use a box for this because this is typically where price is contained between a high and a low, which makes it nice and easy then to read where the sideways ranges are. So as we see here, we get price contained between a high and a low here, sideways range. And like I said, followed by that initiation structure there to the downside. Then price moves into another sideways range. We initiate here to the downside. Then we move into another sideways range here as well and initiate here to the downside as well. Then what does price do? We get an initiation to the upside. Then we get a sideways range here created in the market, breakout to the upside. We move into that trend. Then we also get a sideways range here at the top, followed by that initiation here to the downside. When we start to create that low, we also create a sideways range. Again, orders are being created. We initiate out, pull back, and see continuation. As we can see, when price is contained between the high and the low, this is when orders are being created in the market. We initiate out and then we move right back in. So that becomes just a larger range in the market here, followed by that initiation to the downside. Price then moves into a very large sideways range here before an initiation there to the upside. We then get that pullback and that continuation. This is also a representation of a sideways range here as well, a very large sideways range, followed by an initiation to the upside. Now we can see it might be a little bit messy right now, but all we've done is just identified the market structures. If we're to think about the higher time frame perspective as well, this is one very large sideways range here on the higher time frame.
This week's community winners.
Now you've understood and learned how to read every single market structure. You can use this and train your eyes to read all these market structures. Now we're going to move on to part 2. This is the second most important concept that should be applied to everyone's trading system. Number 2, trading location. This is premium prices, discount prices. This is the edges. This is the middle. This is high prices. This is low prices. They all mean the same thing. It's based on location. Now, the reason why we went through structure first is because you need to understand the structure of the market before you add on location. Because when you understand that we're in trends, then you can find your high and your low, then you can find your price range, which then means that you can find good locations. If you know that price is in a sideways market, you can find the highest price and the lowest price. And then again, you have your price range, which then means that you can look for higher prices and lower prices. When you're in an initiation structure, it's very difficult to find location because price is just going to continue to move higher or lower. So you're only really going to be buying high or selling low in initiation structure. And that's very important to understand. So what we use at NJT, we use this tool here, the fib tool, right? And what we do is we find a high point and a low point. And this is representation of high prices, low prices, and what we call the middle of the range, the slaughterhouse, right? We want to be looking more towards the edges because these are going to be your best prices. If you think about over here to the right, these are prices over here on the right-hand side. These are going to be high prices, low prices. This is how you build your chart IQ. So you add on this tool, and this tool is a representation of the prices that we see here on the right. It's the structure first that we need to understand. It's first the structure that we need to understand. Then we apply our tool onto this structure. And now we have low prices, which is represented here. Again, when we're thinking about low prices, we understand price is contained. And this is a low price. And this is a high price in a contained price range that we see here to the right. So when we're in a sideways range, we then apply on our tool to find the highest prices and the lowest prices. We only want to sell high and we only want to buy low in the market. Now, when price is in a trend, when we're creating A to Bs in the market, this is where we want to be buying low and selling high. Now, typically, we want to be looking more towards the edges, which again is where price moves down into this location, because then you're going to be buying low in a trend. Now, you can also trade the discounted pricing, which is anywhere around here, before then playing that as a continuation. You don't want to be buying high in a trend, and you don't want to be selling low in a bearish trend. You want to be looking for price to come back into discount pricing, and the highest price you can get is going to be your best price. The lowest price you can get is going to be your best price. These are going to be your best opportunities to get into the highest probability moves that are going to see the biggest moves in the market, and the bigger the move, the bigger the profit you can make as well. Now, when we're in initiation structures, like I said, it's very difficult to understand the highest point and the lowest point until price stops and actually pulls back. So typically, when we're in initiation structure, you are either going to be buying high or selling low, or you can just forget about these and understand this is what creates the intention in the market out of the sideways range. And as we see here, when we break out of the sideways range and create that low and that high, that creates that initiation structure. When we start to pull back, now we can apply on this concept here, which is location. We found the low point, the high point. When price pulls back in, this is where we look for the range that broke out. And this is where we create our price range in the market, right? So we know that then we're looking back into the sideways range. That's normally at the buy low location down here. And then we can trade that as that continuation here to the upside. And then we get involved in this move, which is that continuation. So this is why it's key to understanding the fundamentals first, also understanding RAMC, and then you can apply the location on top of whatever market structure you're being presented in the market. So let's go back to our structure examples that we identified earlier. And now let's think about location. So this is what we done earlier, right? We understood when we're in a sideways range, we understood when we're in a trend, and we understood when we're in an initiation. So all I've done is just removed all the initiation structures because we don't trade initiations unless you're going to trade them on the lower time frames and trade those as continuations. So right now, all we're going to do on the 15-minute is just focus on the sideways ranges, and we're going to focus on the trends. Because if you can get involved in a sideways range, you'll catch the next phase, which is that aggressive initiation. When you get involved in the trends, you're anticipating that you're going to get involved in that next higher low or lower high, and then you're going to see that next initiation phase. So if you focus on sideways ranges and you focus on trends, that's how you can get involved in the initiation phases in the market. So all I'm going to do now is I'm going to apply on our location tool in the market, and then we're going to find great trading opportunities. So as we see here, we're in trend, right? We created that high, low, lower high, and lower low. We didn't know it was a trend until we created that lower low. So it's at this point where we create the high and the low that we create our price range. Now, all we want to do is every time price comes back up into these sell high locations, we want to zoom in on the lower time frame and catch that next continuation phase in the market. So as we can see, there were some great opportunities here to trade that continuation to the downside. Again, all we're doing is just identifying at this stage. We're just training our eyes. So then what happens? We move into initiation to the upside. Then what happens? We move into a sideways range. Price is contained between the high and the low. So again, every time price comes into these buy low locations is your opportunity to catch that next move in the market here to the upside. So again, we're just identifying at this stage. Price then breaks out, we move into a trending market. So again, we just find the low and the high, that creates our price range. We pull back into discount and we see continuation to the upside. Price then moves into a sideways range. So again, we can contain price here between the high and the low. Not always going to be opportunities for you to get involved in the moves here, but we can identify great trading opportunities when price does come back into these locations. Then what do we see? Initiation to the downside. Price creates a sideways range here. So again, all we want to do is look for those buy low locations. Anytime price comes back into these buy low locations inside a sideways range, these are your opportunities to catch that next initiation in the market to the upside. Then what do we see? Price then moves to the upside, and all again we're going to do is we're just going to contain price between the high and the low, as we see here. Again, there was no opportunities to take sell highs in this location, but that's absolutely fine. What price has actually done now is created a very large sideways range, as we see here. This will be your higher time frame sideways range where price contains sideways. So again, every time price comes back into these buy low locations, that's your opportunity out of a sideways range to play that next initiation phase in price. So as we see there, then what do we create? We create a low, a high, a high, a low. Then we create a higher high in the market. So we see that price is now moving into a trending market. When we pull back into the discount pricing, this is your opportunity to take that next continuation phase in price as well. Now we can even see price has created a sideways range here as well. So again, we can find our buy low and sell high locations. And every time price moves into that buy low location is your opportunity to catch that next initiation phase within price. You can also see here, price creates another sideways range. So that will be your next opportunity to take buy low locations inside the sideways range before price initiates to the upside. So now all I've done here is I've just identified in 3 days worth of price delivery, sell high and buy low locations using the location concept. If you use both of these concepts together, the location and the structure, you will be able to create a high probability trading plan based on the fact of how price has to move. This would have sped up our journey to consistency when we were learning a lot quicker, because if we knew that there was 3 different market structures and we understood how to trade these market structures, trading at the best prices, we would be able to anticipate those bigger moves in the market. And those are the ones that you want to be in. So now this is number 3, setups. Now with the information that I've shown you already of how to read the market structures, how to identify the best locations in these market structures, what you're going to do is you're going to create setups based on this information. Then you can come to the markets with an understanding of what you're looking for in what structures and what you expect to see next. And this is how you create high probability setups based on the fundamentals of how price actually moves. So like I've shown you here, when you've identified a trending market, once you find the low and the high point and you've applied on your location tool, you could say every time price moves back into discount, I'm going to find ranges at a discounted pricing, and then I'm going to zoom in on the lower time frame. I'm going to trade alongside that intention for that next move in the market. So same with this one here. Once you understand that we're in a trending market here, you can apply on your location tool. You can find ranges created at a premium price, and you can trade these for that next continuation move in the market because you expect that next move. This is one setup that you can have from a trending market. When we're in a sideways ranging market and you've identified that price is contained between a high and a low point, you've applied on the location tool, you can say that when price gets back into discount pricing or when we're in premium pricing, I'm going to look for sells or buys. And this is another setup that you can have in the market. When we're in initiation structure in the market, when we're moving very aggressively, what you might want to do is go to the lower time frame, which means zooming into price, and look for this same representation and trade alongside the initiation structure, either higher or lower. So what you'll do is look for the sideways range structure. You'll look for sell high locations if we're in a bearish initiation, and you'll look for those buy low locations if we're in a bullish initiation. And that's how you create high probability setups that you look for in the market. Thank you all for watching. If you want to find out more about how we trade these markets with precision, visit our website and notjusttotrade.com. You can also message us on Instagram or join our free public Discord using the links in the description of the video. Leave us a like and comment if you enjoyed the video, and we'll catch you guys on the next one.